Welcome to the Daily Drawdown, your fast brief on inflation, the Fed, and the AI capital cycle. A softer CPI print eased rate fears, but the bigger story may be where money is still crowding in hard. AI hardware, data centers, memory, and the banks financing all of it are still driving the tape, while software just took a brutal reality check. June CPI fell 0.2% month over month, the biggest drop since April 2020, and markets treated it as real relief. Short-dated hike expectations dropped sharply, with FedWatch odds for an imminent hike falling from roughly the low 40s to the low teens, and two-year yields moved lower. That eased some bond stress, even as parts of the long end rose, which steepened sections of the curve. The catch is the inflation story still isn't clean. CPI Supercore slowed a lot more than PCE has, so the next question is which series the Fed leans on when it sets policy. Chair Kevin Warsh kept the message disciplined. Fed independence, law, data, and no granular forward guidance. He also laid out a broader policy agenda with 5 task forces covering communications, balance sheet policy, data usage, productivity and jobs, and inflation frameworks, with public reports due by year-end. That matters because it points to process changes, not just the next rate decision, including a review of the balance sheet and possible movement toward more treasury bills on the asset side. On market plumbing, Warsh flagged stablecoin rulemaking deadlines, said access to payment rails should be based on safety and resilience rather than politics, opened the door to a Basel III review, and made clear the Fed will not be a backstop for crypto or stablecoins. IBM was the cleanest single stock warning in the market. It pre-announced a Q2 miss tied to software, and the stock fell about 24 to 25%, erasing roughly $70 billion in value. Management said customers are shifting CapEx away from software and towards servers, storage, and AI hardware. That's why this matters beyond IBM. Investors have been treating enterprise AI spend as broadly positive for tech, but this showed the spend mix can hurt software vendors even while total AI budgets rise. The debate now is whether this is a 1 or 2 quarter timing issue or an earlier structural shift in how customers allocate dollars. Analysts are also separating IBM's long-term quantum ambitions from the actual cash engine, which has historically been higher-margin software and hybrid cloud. On the other side of that software weakness, AI hardware is still running hot. Corporate buyers are pre-purchasing servers, storage, and memory to secure supply and get ahead of price increases, and that is feeding strong demand for DRAM and high-bandwidth memory. SK Hynix surged around its U.S. listing, with reports putting the move in the low to high 20s, and Micron kept benefiting from bullish cash flow narratives. The structural thesis is clear. HBM remains supply-constrained, and SK Hynix is described as holding about 60% share. The trading risk is just as clear. Heavy options flow, ADR premiums, and concentrated derivatives positions mean even a modest earnings miss could create a much larger stock move than fundamentals alone would justify. That same dynamic is showing up more broadly in zero-date options, where same-day trades are helping magnify intraday swings in headline names. One notable pocket of resilience is cybersecurity. CrowdStrike, Palo Alto, Zscaler, and Fortinet have been outperforming broader legacy software, helped by rising AI-related security demand. Palo Alto in particular was cited for a sharp increase in AI security inquiries. The nuance is that stock selection matters more than broad exposure here, because individual leaders have been stronger than cyber ETFs. Bank earnings reinforced that the U.S. economy and capital markets are still carrying more momentum than many expected. Goldman posted very strong results by multiple measures. Bank of America delivered about 34% EPS growth with better returns on common equity, and Wells Fargo showed double-digit wealth management growth after the asset cap removal. The practical point is that banks are not just reporting on the AI build-out, they're financing it. Wall Street is channeling roughly $1 trillion of AI-related capex through bond and equity markets, and firms like Goldman are central underwriters and lenders for data center and semiconductor projects. Consumer data also stayed firm. Bank of America's large payment panel showed roughly a 6% month-over-month spending increase, and the backdrop is still supported by older households with enormous net worth and by improving wage and deposit conditions lower down the income stack. The AI build-out is now running into physical constraints, especially power and land. New York imposed about a 1-year moratorium on large new data centers, and other states are also taking a harder look because of energy and environmental pressure. Meanwhile, the private market is still pressing ahead. CleanSpark announced a 20-year, $6.6 billion lease tied to a Georgia data center. Alphabet used a $1 billion prepaid energy municipal bond to lock in cheaper power, and Meta expanded a reported 5-gigawatt data center plan. What to watch next is whether power access and local permitting become bigger bottlenecks than chip supply, and whether financing structures keep shifting toward tenant contract length to reduce long-duration demand risk. Two final watch items sit outside equities but feed back into risk. In energy, Houthi attacks and broader regional tension kept focus on the Strait of Hormuz. U.S. naval escorts helped keep about 10 million barrels a day moving, but the market is still pricing supply risk with oil near the low to mid-80s. That matters because any renewed spike in energy quickly re-enters the inflation conversation, just as markets are trying to price a cleaner disinflation path. In crypto, Bitcoin rose about 4% on the softer CPI print, but the regulatory line stayed firm. The Fed does not intend to backstop crypto or stablecoins, and upcoming rulemaking coordination still matters more than one-day price action. That's the setup right now: softer inflation, a less certain Fed path, and an AI trade that's still powerful but increasingly crowded. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.